Hey, welcome back to another week in review. Quint, there wasn't a ton going on this week. We did get some economic news. We got some movement in the markets in different areas, but tell us a little bit more.
Yeah, it's nice to have a quiet week. It's been a while, quite honestly.
Definitely.
So we really only got one data point this week that was worthy of talking about, and that's the personal consumption expenditures, PCE.
Okay.
Most people don't know that this is actually the Federal Reserve's preferred inflation gauge. The CPI certainly takes, center stage and is the one that the media kind of refers to, and most people would adhere to when they're talking about inflation. But the Fed really wants to look at the PCE numbers, and that came in as expected. And ironically, that was quite bullish for areas of the market. Why? Well, because if you remember, the CPI was quite a bit higher than anticipated. And dating that was the jobless claims or the non-farm payrolls, which were much stronger than anticipated. So you had some critical data that pointed to maybe higher than anticipated inflation, and that was a hindrance for the market. This week we had in-line expectations, which for the most part, the areas of the market that have been moving, big cap technology, didn't react much either way. However, if you look under the surface, areas that are really influenced by interest rate seem to have a really good move on that. For example, the small caps, which have been dormant most of this year, they're certainly still 20% off highs, if you can believe it. They had about a 3% week, quietly catching up. Other areas like emerging markets and even bonds started to kind of percolate a little bit underneath the surface. So it's interesting to see if we actually do get further inflation data that is lower than anticipated or continues to have that trajectory. I think we could see a pretty significant move in the areas that people have really not been paying attention to.
And those are some of our favorite areas moving forward. Like, that's our expectation, right? So tell us a little bit more about that and why we like those areas moving forward with the Fed and what they're doing too.
Well, I would say the first thing it comes to is valuation. There's always an element of looking at company fundamentals and sort of sector or group fundamentals. And the valuation, what you can pay for a company or what you can pay for a specific area, is much more attractive in the small and medium-sized companies than what is starting to happen in the large cap arena. And that's like, again, equating to what you would buy a car for or a house. You generally say, okay, well, I understand that this car, normally is selling for $30,000. If it happens to be selling for $25,000, you would say that's a value, and you might want to go in and buy that car. If it normally sells for $30,000, but for whatever reason it's selling for $40,000 or $50,000, you might go, whoa, wait a second, that's not a value. Well, stocks are the same way. Companies are the same way. So there's a lot of groups out there that have been trading for a long time below value. Now, that's nothing new. I want to make sure that people are very clear. That's happened for years now. But you need a catalyst. So think of those things that are on sale, right? If all of a sudden cars or real estate or whatever it was on sale, just because it's on sale doesn't mean that it's going to jump right back up in price.
Right.
There's some sort of catalyst that has to happen. In our opinion, the catalyst that would wake a lot of people up to these things being on sale are interest rates coming down. Well, you kind of can't wait for that to happen. You kind of got to get ahead of it. So we're starting to see indication that rates are going to come down. Therefore, a lot of our investment theme right now are the areas we feel will do well as interest rates coming down. So you kind of got to skate where the puck is going. Mind you, we still have positions in the areas that have been doing really, really well,
Right,
which we
right.
like. But when we did a rebalance at the beginning of the year, for instance, we peeled some of those areas back. We tried to reinvest in some of the areas that are undervalued. This is true, too, if you're on the sidelines. I know we have a lot of people that watch these videos and they get our newsletter. If you find yourself on the sidelines for whatever reason, maybe you tried to time the market, that didn't work out so well, or you've been fearful or whatever it may be, there's a lot of areas. When you look at re-entering the market and you go, well, I can't buy the Dow here or I can't buy the S&P right here, I understand optically that could be difficult, but there are a lot of areas that are not at those highs that we like quite a bit here.
Right. Great. Well, I want to take this time too. We've been reaching out to clients and touching base with people, and I've realized that a lot of people don't know that we have a podcast too that we do. We have a podcast called DIY Money. So if you have young people in your life or people that are learning about personal finance that would be interested, even a lot of our clients that you just might be interested hearing us talk about personal finance and not just stocks and bonds and things all the time.
Did you just
Check
call
that out.
all of our clients old?
No, they're not all old. We actually have quite a few of our clients that come from the podcast and from those different areas. I wasn't saying that.
I'm
but
just kidding with you.
yeah, but I encourage you to reach out to people, maybe spread the word about our podcast and give it a listen yourself. It's DIY Money, and you can find it on pretty much any of the podcast sites or Spotify, anything like that.
Great.
Great. Have a great week.